So as we were discussing about the statement of financial position, I said we stopped at a point where we were looking at non-current assets. So other fixed asset, I said very well that you are supposed to be taking a difference between the current year minus previous year all over previous year's figure times 100 to get increase or decrease in percentage. That is where we stopped. And I think based on comparison statement of financial of Guta for the year ending December 2012 and 2013, that is how it's supposed to be compared. If you continue to equity and reserves, we have equity and reserves. You have share capital 50, where you get the difference between 2012 and 2013. Then you are supposed to just use the same format you are using to get the exact figures in either the third and the fourth column interpretation. A good example, if you take revenues and other reserves, if you take the difference of 330,000 and 222,000, you are going to get 108,000. It should be a negative because 2013, which is in this column, then you subtract from the one in this column, which is 2012, then you are going to get negative. Then if you divide this 108 with 330,000 times 100, you're going to get negative 32.7%. Then the total current equity and reserve is 20.4. So what is the interpretation of this? So the interpretation based on this are as follows. Number one, the comparative statement of financial position of the company reveals that during 2013, there has been an increase in fixed assets of 110,000, i.e. 13.49%. Long-term liability to outsider have relatively increased by 150,000 and equity share capital has increased by 200,000. This fact indicates that the policy of the company is to purchase fixed asset from long-term source of finance. Roman 2. The current assets have increased by 152,000, i.e. 26.67, and cash has increased by 20,000. The current liability have increased only by Kenyan shillings 20,000, i.e. 12.9%. This further confirms that the company have used long-term finances even for the current asset, resulting into an improvement in the liquidity position of the company. Roman 3 of the interpretation. Reserved and surplus have decreased from 330,000 to 22,000, and you can see reserve, we have 330,000 to 22,000, meaning in 2012 it is 330, and in 2012 is this, in 2013 is 222,000. So that is the interpretation. Reserved and surplus have decreased from 330,000, which is this, to 222,000, i.e. 32.73. You can see 32.73, which shows that the company has utilizes reserves and surplus for the payment of dividends to shareholders, either in cash or by the way of bonus. So in overall way, the overall financial position of the company is satisfactory, and that is how it is. The overall financial position of the company is satisfactory due to the fact that reserves and surplus have increased. Due to the fact that reserves and surplus has decreased, current assets have increased, then you find that the fixed asset also have increased. So if that is will not be enough, we are making our summary on that issue. Comparative income statement, that one we were looking comparative balance sheet. And with that, I think it's going to mark our end of lesson today. Next lectures, we are going to look at comparative income statement. For today, we were just looking comparative balance sheet. How do we compare balance sheet in financial statement analysis? And with that, we are good to go. So, mark next time we are going to pick on comparative income statement. And thank you for your time. Thank you for listening. Let's meet on the next lectures, and we will start at comparative income statement. Thank you, and may God bless you all. Bye bye.